Crypto degens are going to be degens, but that doesn't mean you need to be clueless for it. One of the most lucrative upgrades brought to DeFi during the crypto recovery run that started in 2023 has been the advent of so-called concentrated liquidity pools. This upgrade raised the yields derived from liquidity pooling from very attractive to downright bonkers insane. I'm talking about 50, 100, 150% APR and upwards. And as it happens, there is a way to bring structure to this opportunity without relying on technical analysis snake oil. So in this video, I'm going to show you how to use quantitative analysis to prime your pooling for maximum efficiency, that is for minimum maintenance and maximum yield. Let's first take 1 minute to recap what liquidity pooling is. Whenever you make a wire transfer to your favorite centralized exchange in order to buy crypto with fiat, the reason why there is a bid and an ask on your screen and you are able to buy and sell is because the counterparties involved with this particular market, be it the exchange itself or outside institutional participants, are engaging in what is called market making. Market making means providing liquidity to both sides of the market in a given pair of instruments, such as Bitcoin against the US dollar, for example. However, the whole point of crypto being to work in a decentralized fashion, for a so-called DEX to be able to offer a bid and ask to crypto traders and remain decentralized, by definition, they cannot rely on centralized outside market making firms to do that for them. So instead, what they need to do is entice private individual parties to bring their own coins for other traders to buy and sell in what is called a liquidity pool. In return, the liquidity providers get rewarded in the form of those given coins traded in the liquidity pool, and also sometimes with extra outside incentives in the form of a particular token that the DEX or the token issuers themselves might subsidize in order to bootstrap a given pool or simply to sweeten the deal and boost their token adoption. So that is our starting point. Now, during the bull run of 2020 and 2021, liquidity pools were essentially flat pools from the point of view of the individual liquidity provider, meaning that whenever you would add liquidity, your coins would be initially added as a $50-$50 mix to the entire surface of the price ratio between both coins. Using the example of Bitcoin against Tether, adding $1,000 worth of liquidity in a flat pool would take the form of adding $500 worth of Bitcoin and $500 in USDT. That liquidity would then be spread out to cover the ratio of 0, where Bitcoin equals $0, all the way to theoretical infinity. Obviously, it doesn't take a genius to understand that your liquidity was therefore spread very thin to cover the entire spectrum of the possible ratio. And consequently, this type of liquidity pooling became very underwhelming in terms of yield once the initial incentives dried up during the bear market and basic economics took over. That is how these pools went from yielding a routine 30+% to a measly 2 to 5% currently, which is absolutely not enough to offset the risk of impermanent loss. The incentives model was not sustainable long term, and everybody knew it, and that is what prompted the innovation of concentrated liquidity pooling in the end. Impermanent loss needs to be offset long-term for liquidity pooling to be attractive. I will not go in detail over what impermanent loss is in this video. You can find it anywhere on YouTube. Just know in a nutshell that as the market evolves and the price ratio of one coin versus the other changes, the liquidity provider ends up owning more of the coin that decreases in value and less of the coin that goes up. So mostly think about impermanent loss as a cost of opportunity first and a financial cost second under extreme scenarios, and you'll be very close to the truth. Now, in the flat pools that appeared in the first wave of DeFi in 2020 and 2021, this impermanent loss would be very gradual because of the liquidity being spread very thin, as I just explained it. Today, because incentives have largely been retired, at least for the well-established protocols, impermanent loss is a real issue because organic yields have dropped so low that they no longer provide a sufficient offset. And the mitigating solution that protocols have found relies on increasing capital efficiency, meaning that liquidity providers now have the option in these new gen pools to concentrate their liquidity within a specific user-defined bracket of price ratio. So let's imagine once again a Bitcoin versus Tether pool and a spot price of $60,000 per Bitcoin. The user could decide, for example, to provide liquidity from $58,000 to $65,000 only. Providing liquidity in a concentrated pool has therefore three effects for the user. 1. Arguably steeper potential for impermanent loss. 2. Higher yields due to increased capital efficiency. And 3. A much more involved experience that transitions from the totally passive income of a traditional flat pool to the requirement of active management and frequent rebalancing as the range is set tighter. So that begs the question, what range should you choose to make the most out of your liquidity? In other words, what range will provide the maximum yield and the minimum amount of rebalancing? Notice how I am not including impermanent loss in the equation here. That is because impermanent loss is an incompressible downside of providing liquidity. If impermanent loss is what you're worried about, then you should not provide liquidity, let alone concentrated liquidity. That is why I am always advocating to provide liquidity for those pools in which you desire to accumulate both sides, aka both coins, and all those pools that generate insane yields from coins that won't get rug pulled. We are not in 2016 anymore. By now, there are many established projects that you know are not going anywhere. And in general, unless you have a proven quantitative trading system that readily enables you to determine a bias in the ratio, such as the free system that I published in this video, what we are going to want by default is define an unbiased symmetrical range. For example, if the price ratio between two coins is, say, 0.40, we're going to target something like 0.30 and 0.50, that is 0.10, over and under the spot ratio. Again, what we should be most concerned about is minimizing the range to maximize the yield and offset impermanent loss as much as possible, while keeping the efficient range as lasting as possible despite market fluctuations. Obviously, correlated pairs are going to be our most desirable bet in this exercise, but of course, the higher the correlation, the lower the yield, everything else being equal. There's no free lunch here. Regardless, what we need to do is get a sense of both the correlation and the scale of the relative volatility between both pairs over a specific time frame. To that end, we will download a time series of the closing daily prices for each coin involved in the pool and construct the ratio as defined by the liquidity pool, like so. But where can you obtain this data, you're telling me? Well, I'm glad you asked. Data can be downloaded for free from sites such as CoinGecko. As you can see, here we have an historical data tab, and if you click on it, you will land on a page where you can download the data series as a CSV file. Now slap both coins' closing price data side by side in Excel, pit both time series against one another, and make sure to match the dates. That's very important. First, we will compute the correlation using the correl function in Excel. As a rule of thumb, you would want to at least have a correlation coefficient greater than 0.8. So let's keep it simple here and take the example of a pool in the Osmosis DEX comprising two altcoins, namely Cosmos, ticker Atom, and the Osmosis native coin, ticker Osmo. In this case, we have a correlation coefficient of 0.9016, so we're good to go. Second, we want to know how this ratio evolves over time. So we compute the ratio of the price of Osmo over Atom for each date. Once done, in a fourth column, we compute the absolute value of the ratio difference from one date to the next in 10-day increments, starting from 10 days ago all the way to 100 days ago. The reason for that 10 to 100 day range is that we want to get a sense of the volatility behavior for up to 3 months out in order to keep the pool rebalancing trades to a minimum while still getting a solid yield. Obviously, you can stretch or narrow that time range as you like, but for the purpose of this example, that is what we'll be using. Then for each one of those increments, we get the average and the median of all data points, add both, and divide by 2. That gives out 10 numbers that should line up like so if plotted on a chart. Lastly, we take the average and the median of these 10 values again, and in our case, we come up with 0.029. Now keep it in mind as we will be using it very shortly. Now let's take a look at the Osmosis DEX and our Atom to Osmo pool. As you can see, the spot ratio currently stands at 0.12 right now. Now, some DEXs like this one offer ready-made options to provide liquidity. Typically, the passive option is the all-time flat pool, which spreads your liquidity across the entire range from 0 to infinity. As the name indicates, it will not require any rebalancing. That is how you will get the 2 to 5% annualized yield that I was talking about. Now, in this case, we would be scoring 2.1%. That is obviously not sufficiently appealing given the risk of impermanent loss. That leaves out 3 other options. The moderate option is the first instance of concentrated liquidity, and we'll use a ready-made range around spot that happens in this instance to be a bracket of 0.1174 and 0.1329. This option yields a far more substantial 70% yield, which is much more appealing. The aggressive option does the same, but with an even tighter bracket of 0.1195 to 0.1308, and obviously delivers an even fatter yield of 95.3%. However, we need to spot here that these automated options have one thing in common. They are cookie-cutter options that do not take into account a realistic assessment of the coin ratio's historical volatility. And that is where the fourth so-called custom option becomes interesting. So what do we know? We know from our previous analysis that a good assessment of the ratio's volatility over the course of 3 months is around 0.029 between those coins. And we know that the current spot is 0.12. So from here, we have two possibilities. We either lay our liquidity in a symmetrical fashion by applying evenly the expected deviation above and below spot, that is 0.029 above and 0.029 below. That would imply a bracket of 0.091 and 0.149. In this case, as depicted here, we're yielding about 9 times the passive yield with 18.3%. Our second possibility is that we can try to finesse the liquidity pool using the latest market action and account for the deviation that occurred over the past month or so. In this case, we can observe that the ratio dipped from 0.168 all the way down to 0.12 over the past 30 days, where it sits currently. So, using that logic, we could apply an aggressive bias to how we lay down our liquidity by readjusting our reference anchor spot from roughly 75% down from the previous high in order to account for potential mean reversion. In this case, instead of adding and subtracting our 0.029 forward deviation from the spot of 0.12, we would apply it from 75% down from the distance between 0.168 and 0.12, that is from 0.132. That would mean an asymmetrical bracket of 0.103 to 0.161. And as expected, the yield improves a little bit versus not discriminating for recent market action and applying the liquidity in a symmetrical fashion. Notice that the Osmosis DEX here provides an estimated yield every time you change the bracket values based on how much this particular pair would have collected over the previous day of trading. Not all DEXs offer that feature, so be vigilant about the features available to you before providing liquidity. Not all DEXs are user-friendly or created equal. Also, keep in mind that these estimated yields are quantified based on the most immediate trading volume. I made this video on a Sunday, so the yields that you are seeing here are lowballing the average by a substantial margin. Now, evidently, there are ways to increase yields beyond what we managed to get. In fact, it is not uncommon to get it to go past 100% APR by tightening the bracket a little more, especially during periods of increased market activity. But remember, our challenge in this exercise was to obtain a decent yield using an objective and actionable method, and that is what we achieved. Obviously, you are more than free to go full degen on it if you want. Just know that it will automatically lessen the lifespan of your range and increase the potential for impermanent loss. And speaking of which, how are we supposed to handle the spot jumping out of the range? Well, here's what I do. I tend to not overreact, and I will generally use the sooner of the following two criteria before I remove liquidity and reapply it with a different range. The first criteria is time-based. I will typically wait for 72 hours to allow the spot to dip back within the liquidity range. However, remember that our yield is only as good as the spot staying within that range. So I will also use a price-based criteria, which is that the spot must have jumped past 25% of the range. Taking back our example, we set up an asymmetrical bracket of 0.103 to 0.161. That trigger price would be 0.088 to the downside and 0.176 to the upside. That is 0.015 above and below the range bounds, or a 25% deviation as measured by the difference between the range bounds. So as soon as either one of these criteria has been met, I will go ahead and readjust. Before I leave you, I want to remind you that liquidity pooling is a trading activity that has many moving parts and variables, and no method will be able to encompass them all. There will always be a point where you need to make assumptions in your model and hold some variables as constants. And that is fine. The main point is to have a consistent method that has strong ties with the statistical reality of the market and build from there. So go ahead, enjoy your high yields, and keep at it. I'll talk to you in the next one.